All right, we're about 3 minutes to the closing bell, which is the Netflix of Friday daily events. Let's bring into the stream Chris Zaccarelli. He's Chief Investment Officer for Independent Advisor Alliance. Let's also bring in Shawn, Cruz, TD Ameritrade, Senior Market Strategist. Good to have both of you here. Shawn, I want to talk to you very quickly. The Fed did something very wonky in regards to supplemental leverage ratios for the banks. What does that mean potentially after the end of March for investors, especially in big banks like JP Morgan?
So I think it's going to have interesting implications for their ability to distribute capital in the forms of dividends or share buybacks. If you remember, the Fed actually asked the banks to suspend buybacks and also put their dividends under a much more strict review. And a big part of what determines that is what's called excess capital. How much are you required to hold and how much do you actually hold? And one thing the Fed did during the pandemic to ease some of those restrictions was to tell banks, look, if you have treasuries, you actually don't need to hold any capital against those treasury holdings you have. And the banks now are going to have that punch bowl sort of pulled away. That's more of a regulatory action from the Fed. And it could actually be the way for them to say, look, we now can actually ease the restrictions we put on your capital distribution plans as well, because it'd be difficult for them to do that while they still have this accommodative policy in place on the regulatory front. But I do think it's going to be interesting to see how this changes bank behavior. JP Morgan actually came out and said they may have to stop taking deposits as a result of this getting pulled back. So I think it really gets into the inner workings of bank balance sheets. And it's going to be interesting to see what we hear more from policymakers and management as banks as we start to see some of these programs that were put in place during the pandemic get pulled away.
Well, certainly it's putting pressure here on a lot of the big banks today. We see banks selling off in today's action. A big reason why the Dow is lower, off just around 178 points. Let's get to Jared Blickery for a closer look at some of the movers into the close. Jared?
Let's go straight to the Wi-Fi Interactive. We see a mixed market here. Dow, S&P 500 in the red, Nasdaq and the small caps in the green. Here's the 5-day price action in the Dow. Yesterday was a pretty bad day, as we know, wiped out the week's gains. Weren't able to reclaim them today. Looks a bit worse on the Nasdaq, even despite being up today. The trend is definitely down in the short term. But let's take a look at the bond market, because that's been guiding a lot of the price action that we've been seeing. And guess what? The 10-year T-note yield has been up 8 weeks straight as of today. We just settled about an hour ago. And 10-year T-note yield has really kind of dictated what kind of styles and factors have been in play. Big sell-off on tech along the way, kind of juicing some of the small cap names and the value cyclical names, hence the Dow. And so those are the trends that we've seen in place. Now, here's a quick look at the Nasdaq 100 before we go to the bell. Standouts, we got Facebook, that's up 4%, and Broadcom. That's joining the S&P 500 as of Monday. People buying it now, it's up 3%. Here's the bell.
And that wraps up the trading week for us, as Jared was just noting here. A bit of a mixed picture as we close out this trading week, at least for today. We have the Dow under pressure, off 233 points, so some selling there into the close. S&P closing just a fractionally lower here, not too far from the flat line. Nasdaq, though, holding on to gains up nearly 100 points. A lot of the action today being driven by that Fed decision out this morning, at least earlier today. It's a big reason why we're seeing a lot of these big banks lower, but it was also quadruple witching. It was also rebalancing here at the close. So that drove a lot of the action here in the final 60 minutes. But we want to bring back in our markets panel. We have Chris Zaccarelli and Shawn Cruz joining us. Chris, let me go to you just as we wrap up this week. Yes, today we're looking at losses in the Dow. However, the Dow yesterday was the only major index in the green. What's your big takeaway from some of the action that we saw this week as we look ahead to next week?
I think what we've seen this week is really just that move from growth to value, from those tech growers from last year, the stay-at-home trade, into the cyclical trade. And although the banks gave up some ground today because of that SLR release that they talked about from the Fed, which we were just talking about before. But ultimately, I think financials still have a lot of room to run. So do industrials and potentially healthcare. Really cyclical sectors like those financials and industrials should do well for the rest of the year as long as interest rates are going higher. And all signs point to interest rates going higher, whether that's the Federal Reserve coming out with a new forecast saying GDP will be up 6.5%, or looking at those T-note yields up to 173 today, which is 40 basis point move in a month, and really a 65 basis points move in 2 months. So the trend is definitely higher for interest rates at this point.
But Chris, is it sustainably higher? And the reason I ask that is we're going to hear from Powell next week on Capitol Hill, and they've said they want to overshoot the 2%, but they don't expect it to be lasting. So Chris, would it pull back quickly?
So I think, the Fed is looking for inflation to be sustained above 2%. And if that's what they're telegraphing to the markets, they're really saying they're going to let the economy run hot. So I don't think interest rates are going to keep moving up at the pace that they've just moved up in the last 2 months, but I think they will grind higher. I think we could definitely see 2% later this year. Now, whether or not we overshoot that or not depends on a lot of factors. If we go above 2%, does the stock market sell off drastically enough? We saw in the fourth quarter of 2018, when the stock market was down almost 20%, the Fed jumped in and basically said they didn't like that tightening of financial conditions. So all bets are off if the stock market really sells off. But at this point, I do think that the trend that we've seen will continue, maybe not at the same pace, but I think we will continue to grind higher, regardless of what Powell's testimony says in the coming weeks.
Shawn, what do you think? Do you think we're going to hit 2% by the end of the year?
Yeah, I think it's possible that we get there. I actually think it's almost likely, but kind of to Chris's point, how fast we get to these levels is really what matters. I think markets can withstand a slow grind higher in rates. They can't withstand more gaps up like we've seen out of interest rates in the past month, because that does send some reverberations through the equities market. So as long as it's based off of growth increasing and a nice grind higher, I think markets will be okay with that. If it's because inflation's getting out of control or just the inflation outlook is getting so uncertain that the premiums are driving up yields, that's not what you want to see moving yields higher. So it's not only a matter of where they go, but it's how fast they get there and why they're getting pushed up those levels.
Okay, but let's follow up on that, Shawn, because the bond vigilantes have not been successful as of yet. The Fed, when we talk about inflation out of control, what's the number that means out of control? Because a lot of investors are reacting to all of these movements without perhaps having a target number in their head as to how to make these decisions.
So anything I would look at as inflation showing signs that it's getting out of control, and you could look at around, say, 2.3% is maybe, all right, you're no longer symmetrical around that 2%. You're now letting it run a little bit hotter. But if we hit 2.3% and we hit that number for a month or two, and then we start moving higher and higher, and you have sustained overshooting of that 2% target, and the market's going to start looking at the Fed to ask, wait, what are you going to do? And are you going to be able to gently rein in inflation? Are you going to have to do something drastic like Volcker had to do in the 80s to sort of tame down inflation? That was almost put in monetary policy that put the economy into a recession. So it's a matter of do we feel like the Fed is in control if we do start overshooting inflation? But it'll also be a matter of, is it transitory or is it just a little bit of a blip on the radar? Because right now, they've admittedly said, look, 2.4% is what we're expecting, but that should moderate back down towards that 2% level. So if you get up to that, I think everyone will be okay because the Fed was expecting it. But if you can't get a sense that they're going to be able to start pulling it back down and moderating to 2%, then the market's going to get concerned.
So, Chris, we have an economic recovery underway. We have a bit of inflation here. How do you play this? What are you favoring?
So I think you really need balance, and that's probably always true, but especially now. You're seeing a sustained move into that value trade, into cyclicals. That's likely to persist. You're going to see that for some time. However, a lot of the companies that are in the technology group that really have great earnings, that have proved very resilient during the pandemic, they've really shown that come the next recession, tech is not a bad place to be. So I think a more balanced approach. Don't be overweight technology like some people probably were at the end of last year. But on the other hand, just don't leave it for dead. I think you want to have more of a balanced approach. So broadening out into financials, industrials, healthcare, maintaining those tech positions, and really looking for some type of a balance in terms of both growth as well as value. And I think that's the best place to be positioned as investors really look at the marketplace right now.
Okay, Shawn, Chris, let's take a quick pause. We're going to go back to Jared Blickery for his final thoughts.
Well, we just had the rebalance, and it might be still ongoing to a limited degree. The S&P indices, that's the S&P 100, 400 for the mid caps, and 500 for the large caps. Well, those have all rebalanced. They're going to have a few new constituents on Monday, and let's take a look at those. Just looking at the S&P 500 over the last year, up over 60%. So guess who's joining from the mid caps? Caesars Entertainment. That's up over 1,000%. That's nearly 10 times what it was 1 year ago. Penn National Gaming, 1,800% year over year, plus NXP Semiconductors. That's up only 165%. Who's out? Flowserve Corporation, Generac Holdings, and also Xerox Corporation. And you'll note that a lot of these stocks have huge gains too, but it's all relative, and it's determined largely by market cap. Do want to make a quick note here. I said Broadcom was joining the S&P 500. It's already in it. It's actually joining the S&P 100. And so these are the 100 largest stocks among the S&P 500. That's up 144% year over year. And we'll be talking and taking a look at some of these names on Monday. Not as big of a deal as when Tesla joined 3 months ago, but still noteworthy nonetheless, guys.
All right, my fellow Coral Gables Senior High alum, thank you very much, Jared Blickery. And also thank you to Chris Zaccarelli, Chief Investment Officer for Independent Advisors Alliance, Shawn Cruz, TD Ameritrade Senior Market Strategist. Good to have both of you here.